Hey guys, what's up? Welcome back to another video. In this video, I'm going to be doing an intrinsic value analysis for another company that I found that's trading way below intrinsic value per share at the moment, and that company is Lennar. And so we can see right here that Lennar is down almost 30% in the same year that the S&P 500 is down almost 20%. So they are underperforming the market at the moment, but as we'll see in this video, the stock price for their stock might actually turn around in the future because they have been reporting some strong earnings growth, and we'll see from their financial statements that their company could be trading at a very attractive buying opportunity. So right here we can see this is Lennar's website, and Lennar was founded in 1954, and they basically specialize in building homes. They're one of the nation's leading home builders, as you can see right here. And so if we go into their financial statements and their balance sheet, we can see that their total assets are being compared here on their balance sheet for the period ended August 31st, 2022 to November 30th, 2021. And we can see during that time period that their total assets increased by a little over $2 billion, from about $33 billion to $35 billion. And if I scroll down here, we can see their liabilities and their equity. Most of their business is financed by equity as opposed to liabilities. They have about $12.2 billion of liabilities and about $23.1 billion of total equity. But as we can see from their total equity account, there's some good news here because their additional paid in capital account has decreased over this time period while their retained earnings account has increased, and that's resulted in the overall increase in their total equity. And so if their contributed capital account is decreasing, that means that they're buying back shares of their company, which is obviously going to increase the share price of their common stock in the long run. And if their retained earnings is increasing, that means that their total stockholders' equity is increasing as a result of earned capital from positive earnings on their income statement, which is also a very good sign to see for the growth of a company. And so we can see right here for their income statement, they reported revenues from their home building operating segment of about 6.5, or not 6.5, about $8.5 billion, which is up from $6.5 billion in the 3 months ended August 31st, 2021, 1 year ago. So that's an increase of about 30% year over year. And if we were to subtract all of their home building operating revenues, or find the difference between their home building operating revenues and their home building costs and expenses, we would find that the gross profit came out to be about $2.5 billion for the period ended August 31st, 2022, compared to $1.8 billion for 2021. And so their gross profit margin year over year actually increased from 27.3% to 29.2%. So not only did their gross profit increase, but their costs and expenses to obtain that gross profit actually increased at a slower rate than the actual gross profit itself. So that's definitely a good sign. And then lastly, we can see their net income came out to be about a little under $1.5 billion, which is an increase from about $1.4 billion 1 year ago. And the last financial statement I'm going to look at is the cash flow statement. And we can see right here that their net cash provided by operating activities came out to be about $550 million for the 9 months ended August 31st, 2022, compared to $1.3 billion for 2021. And that primarily came as a result of a massive increase in inventory, which, if they're able to sell off the inventory in the future, will obviously result in increased revenues and profits for their company. And then lastly, for their financing activities in their cash flow statement, we can see that they've repurchased about $918 million worth of common stock in the first 9 months of their 2022 fiscal year, compared to only a little under $500 million for 2021. And then they've also paid out about $330 million in dividends for 2022, compared to only about $230 million in 2021. So Lennar has definitely been prioritizing returning a ton of value back to their shareholders this year. So for anyone who is holding shares of Lennar, they've definitely experienced the upside there. And so now what I want to do is look at this discounted cash flow model to figure out the intrinsic value per share for Lennar. And so we can see right here that Yahoo Finance is estimating that Lennar is going to grow at about 23% for the next 5 years. And so I was conservative and I cut that value in half to about 11%. Their free cash flow was about 2.83 or $2.8 billion for 2021. They have a net debt position of about $4.7 billion on their balance sheet, and they have about 250 million shares outstanding. So after taking these values into account, we can see that their intrinsic value per share comes out to be about $300 per share, with a 50% margin of safety of $148 per share. And so that basically means that Lennar is trading at a very steep discount relative to their estimated intrinsic value per share. They're trading far below a 50% margin of safety right now at about $73 per share. So they could present a strong buying opportunity. But as we'll see on the right hand side here, I also did a competitor analysis comparing them to some of their main competitors like D.R. Horton and MDC Holdings. And when we compare these business efficiency financial ratios to each other, we can see that Lennar's gross profit margin is one of the highest out of the three, right about the middle of the pack at about 27%, compared to D.R. Horton's 28% and MDC Holdings 22%. They have the highest net profit margin at 16%, and they have the second highest return on assets at about 13.86%. So their business efficiency in terms of getting a return on their business is second only to D.R. Horton, but they do have the most profit for their bottom line, their net profit. So based on this competitor analysis, it looks like Lennar is pretty competitive in their industry. And then obviously from an intrinsic value standpoint, it looks like Lennar is definitely trading at a pretty steep buying opportunity right now. But considering the fact that over the last year, their stock price has underperformed the overall market, and over the last 5 years, their stock price has also underperformed the overall market. It's difficult to tell whether from this point going forward, Lennar will start to outperform the market. Obviously, they are trading at a pretty steep discount, so it is possible that Lennar will start beating out the market. And on top of that, we can see they're trading at a very conservative PE ratio of only about 4 times earnings, which is pretty low for a stock in this industry. But I'm not too sure what to think about Lennar at the moment. I'll definitely keep my eye on the stock, but I'd love to know what everyone watching this video thinks about Lennar. Is it a good buying opportunity right now? Let me know in the comments section down below. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.